Close your eyes and imagine the sound of a telephone ringing in the corner of a corner office high above Manhattan. For most people, a ringing phone is a mundane part of the workday, but for the chief executive officer of a Fortune 500 company in the 1980s, that specific ring could signal the end of a career. On the other end of the line was a man who did not care about traditions, corporate hierarchies, or the status quo. His name was Carl Icahn. For 5 decades, Icahn was the specter haunting the dreams of American boardrooms. He was the ultimate corporate raider, a term that conjures images of pirates boarding defenseless ships to seize their gold. He didn't just buy stocks, he bought influence, leverage, and fear. When Icahn showed up on a company's doorstep, it meant change was coming. Whether the management liked it or not, he was the man who could move markets with a single tweet and dismantle industrial giants with a single letter. At his peak, he stood as one of the wealthiest people on the planet, a billionaire who styled himself as a champion for the common shareholder, while amassing a fortune that rivaled small nations, but every empire faces its winter. Behind the decades of aggressive takeovers and billion-dollar wins, a storm was brewing that would eventually challenge his status as the king of Wall Street. This is the story of a man who changed the rules of capitalism, built a legacy of disruption, and finally met an adversary that even he couldn't simply outmuscle. The journey to becoming the most feared man in finance did not begin in a mansion or a boardroom. It began in Far Rockaway, Queens, where Carl Icahn grew up as the son of 2 teachers. Unlike the silver spoon dynasties that often populated the upper echelons of New York high society, Icahn was a product of the public school system and a fiercely intellectual environment. He was a competitive kid who excelled in academics, eventually making his way to Princeton University. He studied philosophy, a choice that might seem odd for a future financier, but it provided him with a unique framework for logic and argumentation that would serve him well in later battles. After a brief and unfulfilling stint in medical school and a period of service in the Army, Icahn found his true calling in the heart of the financial district. He started as a trainee stockbroker in 1961, right as the post-war economic boom was shifting into a more complex era. He wasn't just there to trade, he was there to observe. He quickly realized that the markets were often inefficient and that many companies were being run by management teams who owned very little of the stock they were supposed to be protecting. These executives were comfortable, bloated, and vulnerable. Icahn saw an opening. By 1968, he had borrowed enough money to buy an individual seat on the New York Stock Exchange and formed his own firm, Icahn and Company. It was here that he began to refine the strategy that would make him a legend, finding companies where the value of the pieces was worth more than the whole. In those early days, the concept of a corporate raider was still being defined. Icahn was one of the pioneers who realized that if you bought a significant enough stake in a company, you didn't have to wait for the stock price to go up on its own, you could force it up. He looked for companies that were undervalued, often because they were sitting on piles of cash or valuable real estate that the market wasn't properly pricing. His method was simple but devastatingly effective. He would buy a large block of shares and then start making noise. He would write letters to the board of directors demanding changes, such as selling off divisions, firing the CEO, or paying out massive dividends. If they refused, he would launch a proxy fight to replace the board with his own hand-picked candidates. This was a radical shift in how business was conducted. Before Icahn, the relationship between shareholders and management was often polite and passive. He turned it into a contact sport. Shareholders frequently loved him because his arrival usually meant a quick spike in the stock price. Executives, however, viewed him as a barbarian at the gate, someone who cared nothing for the long-term health of the company or its employees and only wanted a quick profit. This tension became the hallmark of his career. He wasn't just an investor, he was an activist who used the threat of a takeover as his primary weapon. The 1980s provided the perfect backdrop for Icahn's rise to national prominence. It was an era of deregulation, junk bonds, and aggressive capital. Perhaps his most transformative and controversial campaign was the takeover of Trans World Airlines, better known as TWA. In 1985, Icahn seized control of the legendary airline, but unlike his previous deals where he might just flip the stock for a profit, he actually took over the operations. It was a brutal tenure. He stripped the company of its most valuable assets, including its lucrative London routes, and used the airline's own cash to pay off the debt he used to buy it. While Icahn made a personal fortune from the deal, TWA eventually spiraled into bankruptcy, leaving a trail of lost jobs and a gutted legacy. This solidified his reputation as a ruthless tactician. He followed this with a massive battle for Texaco, which ended in one of the largest settlements in corporate history at the time. He moved on to RJR Nabisco, playing a key role in the legendary war for the tobacco and food giant that was immortalized in the book Barbarians at the Gate. Even in the world of entertainment, he made his mark by swooping in during the bankruptcy of Marvel Entertainment in the late 1990s. He fought for control of the comic book publisher, and while he didn't hold it long enough to see the birth of the Marvel Cinematic Universe, his involvement helped reshape the company's financial future. As the decades turned, Icahn showed a remarkable ability to adapt to new industries. He wasn't just a relic of the 80s, he was a force in the digital age. In the mid-2000s, he targeted Motorola, forcing the company to split its mobile phone division from its networking business. This move eventually led to Google's acquisition of Motorola Mobility for billions. Later, he took a massive position in Apple. At the time, Apple was already a titan, but Icahn argued that the company was sitting on too much cash. He publicly pressured Tim Cook to initiate massive share buybacks, essentially demanding that the company return more money to its investors. His persistence paid off, and Apple launched one of the most significant capital return programs in history, adding billions to Icahn's personal net worth. Then there was the legendary saga of Herbalife. This wasn't just a financial play, it was a personal grudge match between two of Wall Street's biggest egos. Short seller Bill Ackman had publicly bet $1 billion that Herbalife was a pyramid scheme doomed to crash. Icahn, sensing an opportunity to squeeze his rival, took the opposite side. He bought a huge stake in the company and publicly insulted Ackman on live television. The battle lasted years, but eventually Icahn emerged victorious as Herbalife's stock held steady, forcing Ackman to exit his position with massive losses. It was a masterclass in psychological warfare and market positioning. By the early 2000s, Carl Icahn reached his peak power. He was no longer just an investor. He was a political and economic influencer. His fortune had grown into the tens of billions of dollars, and his firm, Icahn Enterprises, had become a diversified holding company with interests in energy, automotive parts, food packaging, and real estate. He was a regular fixture on financial news networks where his mere presence could sway the price of a stock by 5 or 10% in a matter of minutes. This phenomenon became known as the Icahn lift.
Icahn, what's your take on Herbalife? I'm buying.
Buy HLF, it's moving!
His philosophy was centered on the idea that American corporations were poorly managed and that by shaking them up, he was actually helping the broader economy. To his supporters, he was a visionary who unlocked trapped value and held leaders accountable. He was the king of activist investing, the man who had turned a niche strategy into a dominant force in global finance. However, with great power comes intense scrutiny and growing criticism. As Icahn's influence grew, so did the chorus of voices questioning his methods. Critics argued that his brand of activism was essentially a form of financial engineering that prioritized short-term stock gains over long-term stability. They pointed to companies like TWA as evidence that Icahn's primary goal was to extract wealth, often leaving the underlying business in a weakened state. Labor unions and employees often bore the brunt of his cost-cutting measures. Furthermore, some market observers began to question whether his public campaigns were becoming more about his personal ego than about sound investing. The high-profile nature of his battles, especially the Herbalife saga, led to accusations that he was using his market-moving power to settle personal scores. There were debates about whether his tactics were still effective in a modern market that was becoming more transparent and where other activist investors were using more collaborative approaches. While Icahn remained a formidable figure, the world around him was beginning to change, and the aggressive, confrontational style of the 80s raider was starting to look increasingly out of step with the new era of corporate governance. The turning point began to manifest as the 2020s approached. The market landscape was shifting, private equity firms were becoming more powerful, and passive investing through index funds meant that large institutional investors now held the keys to most boardrooms. It was becoming harder for a single individual, even one as wealthy as Icahn, to bully a major corporation into submission. Furthermore, Icahn Enterprises, the publicly traded vehicle through which he conducted much of his business, began to face its own internal challenges. The company, which operated as a master limited partnership, relied on a high dividend yield to attract investors. To maintain these payouts, the company needed a constant stream of successful investments and potentially the issuance of new shares. Some analysts began to look closely at the math behind this structure. They questioned if the value of the assets inside the company actually justified the high stock price. The fortress that Icahn had built over half a century was starting to show small cracks, and in the world of high finance, a small crack is often all a predator needs to start circling. The most significant blow came in May 2023. A short-selling firm called Hindenburg Research, famous for taking down high-flying companies like Nikola and Adani Group, released a scathing report targeting Icahn Enterprises. The report was titled, "The Corporate Raider Throwing Stones from His Own Glass House." It alleged that Icahn's company was significantly overvalued, claiming that it traded at a premium far above its net asset value. More damagingly, the report suggested that the company was using a Ponzi-like structure, using money from new investors to pay out dividends to old ones. It also highlighted a large personal loan Icahn had taken out, backed by his own shares in the company, which created a risk of a margin call if the stock price fell. The reaction from the market was swift and brutal. The stock price of Icahn Enterprises plummeted, wiping out billions of dollars of Icahn's personal net worth in a matter of days. For the first time in his career, the hunter had become the hunted. Icahn fiercely denied the allegations, calling the report self-serving and inaccurate, but the damage was done. The report forced him to restructure his personal loans and significantly cut the company's dividend, a move that only added more downward pressure on the stock. It was a humbling moment for a man who had spent his life pointing out the flaws in everyone else's balance sheets. The aftermath of the Hindenburg report left the financial world wondering what would happen to the legacy of the man who had dominated it for so long. Regardless of the recent setbacks, Carl Icahn's impact on Wall Street is undeniable. He was the catalyst for the modern era of shareholder activism. Today's major investment funds and activist hedge funds all use the playbook that Icahn spent decades writing. He proved that management is not untouchable and that owners have the right to demand more from the companies they actually hold. He forced American industry to become leaner and more competitive, even if the process was often painful. But his story also serves as a cautionary tale about the limits of power and the dangers of financial engineering. Was he a visionary disruptor who cleared out the dead wood of corporate America? Or was he a symbol of Wall Street excess who prioritized his own wealth over the well-being of the companies he touched? The answer likely lies somewhere in between. As he enters the twilight of his career, Icahn remains a polarizing figure, a man who built a fortune on conflict and change. He showed the world that in the high-stakes game of capitalism, no one is safe, not even the man who spent 50 years making everyone else afraid to pick up the phone. Ultimately, the story of Carl Icahn is the story of the modern American economy itself, ambitious, aggressive, immensely successful, and always just one phone call away from a crisis. In the end, his greatest victory and his greatest challenge were one and the same. He taught the world that in business you are only as good as your next move.